Hi, Nirothambi Pillay from Investment Rise. And today I want to look at a situation that many people are a little confused about when it comes to getting the right loan. What I'm talking about is the difference between a principal and interest loan versus an interest-only loan, especially on your home. So first of all, what I want to draw up is what's called in the banking industry a loan amortization graph. All right, and so what that looks like is, here we go. We have dollar value or debt value over here on the left-hand side, and then we have time on the right. And let's say we've got a mortgage here of $600,000. Probably a bit conservative for Sydney mortgages, but let's go with that. And how it looks like is this. So you can see, and so this is literally this curved line is how quickly you pay off your mortgage. And as you can see, initially you hardly pay it off at all, and then it gets faster and faster over time. All right. So that's how quickly you pay off your loan, which is something we will look at in another video. But what I want to look at now is the difference between principal interest and interest-only loan. So $600,000 mortgage, currently interest rates are at record lows. Let's stick with that. And normally, if you've seen any of my other videos, you know I use the long-term average, but in this situation, we can actually use the current low interest rate. So let's just say an interest rate of 4%. Okay. Now, if you make a principal and interest payment, and I have worked that out already, that is $2,864 per month. So that's what you'd be paying each month towards your mortgage. Now, if you make an interest-only payment though, the repayment is $2,000 per month. So that's the difference here, okay, with interest only. Now, that's fine, that's cash flow, but let's look at what it actually means. So, if you're making a principal interest payment of $2,864 per month, okay, you're obviously paying down your mortgage, all right, okay, and let's just say you paid down over some point in time to something like $550,000, maybe a bit smaller, it says $550,000. So what you've done is you've reduced your loan by $50,000, which initially seems like a great thing. But now what happens if you need $20,000 extra for something, unexpected expense or whatever situation is? Can you go back and access this $50,000? Well, not really. It's gone. I mean, the only way you can get it is if you were to go back to the bank, cap in hand, do a refinance situation, get the bank through a new valuation. Hopefully you still qualify in the new bank's lending criteria, or the bank's new lending criteria rather, and then get the $50,000 back and pay some fees and everything else for the process. All right? Because with a principal interest loan, once you start making these repayments, the loan facility, so the ability for you to redraw on that money, is actually reduced. Now, but what you can, however, make extra repayments. A lot of these P&I facilities these days allow for you to make extra repayments. And so if you say make an extra, say $30,000, okay, so now you're sitting at $520. You just paid off another $30,000, so that says 30K. You can, what you've done is if you got down to $520,000, you've reduced your loan from $600 to $520, so down by $80,000, yeah? However, you can only go back and get that $30,000 out of your mortgage. So $50,000 is gone, as I said initially, unless of course you go and refinance. Okay, so especially if you're an investor and you want to now say, okay, I want to buy an investment property, well, you've only got access to $30,000. That 50K is gone unless you refinance, all right? However, if you now look to do an interest-only loan, the situation changes. Because with an interest-only loan, what happens is you're only paying $2,000 per month, so therefore, your loan stays at $600,000. right? And you might think, well, that's not very good. I'm not paying down my debt. Well, yeah, because what you would do, you see this extra $864? Okay? You would still make that payment, and you would either do it straight into the loan to start bringing the loan down, or into an offset account, right? Either way, what you're going to do is literally by having an interest-only facility, but by making the same payment as you would on a P&I, what happens is if you are able to bring your loan down to $520,000, okay? Now, so you've now got your loan down to 520 from 600 as previously. In the principal interest scenario, you can only go and get $30,000 because that's how much you're ahead on your mortgage. Anything else, you got to go refinance. But with an interest-only facility, you can go and take that full amount back at any time you choose. So now if you want to go get that investment property, just by having your personal home as an interest-only facility, you've now got $80,000 to use as a deposit to go and buy an investment property versus $30,000. All right. So there are people out there who say interest-only facilities on your home are dangerous because you're not actually paying down the debt, right? Okay, and that's why you need to make sure you're getting the right strategic guidance. But the key thing is, what's your end game? Are you looking to create financial wealth for yourself? Are you looking to invest? Are you looking to build a portfolio of properties? If so, you want maximum flexibility and you want access to your money easily without having to constantly refinance and paperwork and everything else. And that's why having an interest-only facility on your home gives you more flexibility to redraw money for investment, redraw money in the case of emergencies. Whatever the case is, sure, you've got to manage your money, absolutely, that's definitely key, and you need to follow a plan, but at least here you can understand that by having interest-only facility that allows you to make extra repayments, you're still paying down the debt, so you're still down to 520 over here, as it was over in the principal interest scenario, but the difference is the money you've paid off, you can go and take back whenever you need to, whenever you want to. And that's how I always recommend, if you can have an interest-only facility on your home, if you're looking to build equity and look to invest, then this is the way to go. I really hope that that's helped you. Again, this is just a general situation. It's obviously not personal financial advice. Any questions, leave me a comment below. I look forward to speaking to you soon. Bye for now.